Welcome to the Opening Bell Report.
Okay, let's play a little game. Imagine you're a scientist. You spent, a decade of your life working on one new medicine.
A lot of late nights in the lab.
Totally. You raise millions of dollars, you convince all these investors to trust you, you get hundreds of patients for a massive clinical trial, and then finally the day comes, you see the data.
The moment of truth.
Exactly. And the news is, it's good. You actually hit your main goal. You prove, statistically, that your drug works. It cuts down severe asthma attacks by 56%.
Which is a huge number in this space.
Yeah.
A real win.
Right. You'd be popping the champagne, calling your mom, maybe, looking at vacation homes on Zillow.
You would certainly think so. That's a career-defining moment.
Well, welcome to the completely upside-down world of Wall Street. Because on February 11th, 2026, a company called Upstream released data just like that. And instead of a victory lap, the market took them out back and just crushed them.
It's an incredible story. We're talking about a stock price collapse of nearly 32% in just 48 hours.
It's a paradox, right? Success equals failure. How does that even happen?
Well, that's what happened to Upstream Bio, ticker symbol UPB.
It is baffling. And honestly, it's a little scary if you're an investor who, relies on logic. So that's our mission for this deep dive. We're unpacking a really comprehensive analysis report from February 14th, 2026.
And the title is pretty provocative.
It doesn't pull any punches at all. It's called The $100 M Mistake.
And that title, it really frames the whole tension here. The report is basically arguing that the market made a massive miscalculation. Traders saw a set of mixed data, they panicked, and they decided that a clinical success was somehow a financial disaster.
So we need to figure out how a company hits a home run or, maybe a solid triple and gets punished like they struck out. We're going to break down the drug, the competition they're facing, and the math that suggests this might be one of the biggest emotional overreactions we've seen in biotech all year.
It's a classic case of market psychology colliding with medical science. And usually when those two things crash, you find some opportunity in the wreckage.
All right, let's start with the basics. Set the scene for us. Who is Upstream Bio? Are they a household name?
No, not yet. They're what's called a clinical stage biotech. So that means they don't have a product on pharmacy shelves right now. They're in the cash burn phase, spending money to prove their science works.
And what's their main asset?
Their crown jewel is a drug called Verekitug.
Verekitug. Okay, that sounds like something I'd order at an IKEA cafeteria. You have to unpack what that actually is.
It's definitely not a meatball. It's a TSLP receptor antagonist.
Okay, hold up. TSLP receptor antagonist. That is a mouthful. Before we get into stock prices and millions of dollars, what does this stuff actually do inside a person? Why should we care?
Fair point. Let's strip away the jargon for a second. Think of an asthma attack, like a forest fire in your lungs.
Okay, I'm with you.
Most drugs on the market today, they're like firefighters showing up with hoses. They're treating the inflammation after the fire has already started.
Right.
TSLP is different. TSLP is a protein that acts like the match that starts the fire in the first place. It's at the very top of the inflammatory cascade.
Ah, so that's why they're called Upstream Bio. They're stopping it before it even starts.
Exactly. They block the receptor. They prevent the immune system from, freaking out. It's a very elegant approach.
Yeah.
And Upstream isn't just trying to show that it works. They're trying to disrupt the lifestyle of asthma patients.
Right, because these treatments usually involve injections, and nobody wakes up excited to give themselves a shot.
Precisely. This is the holy grail for this market. Yeah. It's not just does it work, it's how often do I have to deal with it. The goal for Upstream is best-in-class dosing. They want patients to inject themselves way less often than the current options. That's their whole selling point. Freedom.
Okay, stage is set. They have the match-blocking drug. They want fewer shots. So February 11th, 2026. The Valiant trial results come out. This is their Super Bowl. What did the data say?
Well, this is where it gets complicated, and it's where the market got confused. The trial tested two different dosing schedules. The first was a 12-week dose, a shot once every quarter.
4 times a year. That sounds pretty good.
It is. And in that 12-week group, the drug cut down on asthma attacks, the AAER, by 56%. It met the primary endpoint, a clear statistical win.
Okay, pause right there. 56%. If I'm a patient suffering from severe asthma and you tell me I can cut my attacks in half with just 4 shots a year, I'm signing up immediately. So why did the stock crash?
Because they got ambitious. Or maybe greedy. They were aiming for the stars and they missed. They also tested a 24-week dose.
So a shot only once every 6 months.
A biannual shot, yes.
Wow, 2 shots a year. That's almost like a cure in terms of lifestyle. You'd barely even remember you had asthma.
It would be a game changer. But the data didn't hold up. The 24-week dose only showed a 39% reduction in attacks.
Ah, okay. So the quarterly shot worked great, but the 6-month shot was,
It was weak. It didn't meet that high bar set by the competition. And the market's reaction was just Brutal. The stock plummeted from around $16 down to about $8.75.
That's a bloodbath. It completely erased all the gains the stock had made over the last 12 months.
Pretty much, yeah. The market saw that failed 6-month data and decided the entire company was worth half of what it was the day before.
But wait a second. I have to play skeptic. Wall Street isn't usually stupid. These are smart people. They have algorithms. If they sold the stock down 32%, they must have seen something really bad, right?
That's the billion-dollar question.
Does the failure of the 6-month dose mean the drug itself is broken?
The bears, the pessimists, they're arguing that if the drug fades out after 6 months, maybe it's not potent enough to compete. But the report we're looking at argues that's completely the wrong way to look at it. And to understand why, you have to look at the competition, the moat.
Okay, let's do that. Who are the gladiators in this arena? Who are they up against?
The report breaks it down into 3 major players. First, you have the reigning champ, Amgen. Their drug is called Tezspire. It's a blockbuster, the current standard of care.
And it works well.
It works very well. Also, about a 56% reduction in attacks, just like Upstream's successful dose. But, and this is huge, but Tezspire requires a shot every 4 weeks.
Every 4 weeks, so 12 shots a year.
12 shots a year. Monthly. It's pill fatigue, but for needles. It's a huge burden for patients.
Right, so Amgen is the monthly monster. Who else?
And then you have the new challenger, GSK. Their drug is called dipemokimab.
I'm not even going to try to pronounce that. Let's just call it GSK.
Good call. GSK is the real threat here. Their drug is also effective, about a 54% reduction. But here's their ace in the hole. It only requires a shot every 24 weeks.
So GSK is the one that actually pulled off the 6-month schedule.
Exactly. GSK is the leader for long-acting treatment. They're an $85 billion company. And then there's our little underdog, Upstream Bio.
Okay, so let me piece this narrative together. Wall Street looked at this and basically said, Upstream tried to beat GSK at the 6-month game, and they failed. End of story.
That is precisely the narrative. And the report uses a great analogy. Think of it like an Olympic race. Wall Street wanted Upstream to win the gold medal to match GSK's 6-month dosing.
And they didn't.
They didn't get the gold.
But they didn't come in last either.
No. They beat Amgen. Remember, Amgen is the current standard, the market leader, with monthly shots. Upstream offers the exact same efficacy as Amgen, that 56%, but with only 4 shots a year instead of 12.
So if GSK is gold, Upstream is silver, and Amgen is bronze.
In terms of convenience, yes. And this is the key insight from the report. Wall Street is pricing Upstream like they didn't even place in the race. They're ignoring the fact that a silver medal, a quarterly option, is still a massive commercial upgrade over the monthly shots that billions of dollars of patients are taking today.
That actually makes so much sense. I mean, if you asked a patient, do you want 12 shots a year or 4? It's a no-brainer. They're going to pick 4.
Every single time. The report argues that even if Upstream isn't a GSK killer, it's definitely a superior alternative to Amgen's drug. But because the market had this binary beat GFK or bust mindset, they just missed the value entirely.
Okay, so the product has value. That seems pretty clear. But let's talk about the stock price, because the math in this report is it's kind of startling. It's called the $100 a mistake. Walk me through those numbers.
Right. This is where we get into the deep dive on the financials. After the crash, Upstream's market cap, the total value of all its stock, is sitting at about $473 million.
Okay. $473 million.
But here's the kicker. You look at their balance sheet, and they have roughly $372 million of just cash sitting in the bank.
Wait a minute. So almost 80% of their company's value is just literal cash.
Exactly. To really understand how absurd this is, you have to look at what's called enterprise value, or EV.
Okay, break that down.
Okay, let's say you want to buy a house for $473,000. That's the market cap. You buy the house, you get the keys, you walk inside, and you find $372,000 in cash sitting on the kitchen table. Cash that is now yours.
So I paid $473K, but I instantly got $372K back. The actual cost of the house itself was only about $100,000.
Bingo. That's enterprise value. In Upstream's case, the EV is roughly $100 million.
So the market is saying that all of Upstream's patents, their scientists, their labs, this drug that we just established works really well. All of that together is only worth $100 million.
That's exactly what the market is saying. And the report highlights just how ridiculous that is. Developing a drug with 56% efficacy to this stage, it costs hundreds of millions of dollars. To value that entire pipeline at $100 million is basically pricing the intellectual property at near zero.
It seems completely disjointed, but I have to push back again. There has to be a catch. I'm looking at their income statement in this report, and it's a sea of red. Operating income, negative $143 million. Net income, negative $135 million. They are burning cash like crazy.
That's a valid fear.
Isn't the market just saying, yeah, you have cash, but you're just going to set it all on fire?
It's what the report calls the cash incineration phase. And you're right, seeing those negative numbers is scary. But you have to remember the biotech business model.
It's not about profit yet.
Not at all. You can't use a PE ratio because there are no earnings. For a pre-revenue biotech, the only metric that really matters is cash runway.
How long until they go broke?
Blunt, but yeah, accurate. Upstream has $372 million in the bank. Their annual burn is about $135 million. So if you do the simple math, that gives them about 2.5 years of cash left.
And 2.5 years is a decent amount of time in this world.
In biotech, it's a lifetime. It means they aren't desperate. They don't have to do a dilutive offering, selling more stock at these low prices just to keep the lights on. That's the death settle for a lot of biotech.
Upstream doesn't need to do that.
No. They have a massive safety net. They have a time to pivot, to focus on the 12-week data and let the stock recover. They don't have to panic, even if shareholders are.
And speaking of panic, let's talk about the market psychology here. The charts tell a story, too. The report uses some technical terms that paint a really clear picture of how irrational this was.
It used the phrase gap and crap.
Which sounds unpleasant, but I assume it has a financial meaning.
It does. It's trader slang. The stock opened way lower, that's the gap, and then it just sold off all day long, that's the crap. It basically means total capitulation. Investors just wanted out at any price.
They weren't thinking, they were just selling.
Just hitting the sell button. And then there's this metric, the RSI, the Relative Strength Index. It measures momentum. Anything under 30 is usually considered oversold. Upstream's RSI hit 18.0.
18? That seems incredibly low.
It is extreme. An RSI of 18 suggests absolute panic selling. It means everyone who wanted to sell has probably already sold. When you see a number that low, combined with the cash position, the report suggests a dead cat bounce or technical recovery is highly likely.
A dead cat bounce.
Yeah.
Lovely imagery.
It just means a temporary recovery. The report is forecasting a bounce back to the $12 to $14 range as value investors start to notice a company trading for basically its cash value.
So let's tie this back to that binary mindset you mentioned. It really feels like Wall Street is just bad at dealing with nuance.
That's the heart of the issue. Traders treated this as binary. Option A, beat GSK, stock goes to $40. Option B, don't beat GSK, the company is dead.
But reality is almost never that simple. It's always in the middle.
Exactly. They didn't beat GSK, but they didn't die. They landed in this very profitable middle ground, a drug that is far more convenient than the current market leader. The market just hasn't figured out how to price second place yet, so it priced it as last place.
So it sounds like a real opportunity for anyone who can look past the scary red headlines.
That's the core argument of the report. The fundamentals, the cash, the data are disconnected from the stock price. The silver metal is still worth a lot of money, but it's being sold for scrap metal prices right now.
Okay, let's recap. Upstream Bio, they missed the home run, the 6-month dose, but they absolutely hit a triple with the quarterly dose.
Correct. They secured that silver metal in a multi-billion-dollar market. But because Wall Street was betting on gold, they punished the stock by 32%.
And now the company is trading at an enterprise value of just $100 million, despite having a successful drug and nearly $400 million in the bank.
It creates this massive asymmetry. The downside is limited because it's already trading so close to its cash value. The upside, though, depends on the market waking up and realizing a quarterly shot is still a highly valuable product.
The verdict from the report is pretty sharp then. Buying at $8.75 is like buying a silver medalist for the price of just some random participant.
That's the takeaway, a value play born from an emotional overreaction.
It really makes you think about how inefficient the market can be. We assume prices always reflect reality, but sometimes they just reflect panic.
The market is a voting machine in the short term, but a weighing machine in the long term. Right now, the voters are panicking. But the weight of the cash and the data hasn't changed.
I love that. Okay, before we sign off, I want to leave everyone with a final thought. We've been focused on Upstream Bio, but this pattern, that probably isn't unique.
Definitely not. This happens all the time in biotech.
So if the market can make a $100 million mistake on a company with clear scientific data numbers that are literally black and white, where else in the biotech sector is good news being disguised as failure just because it wasn't perfect news?
How many other silver medalists are sitting in the bargain bin right now, just waiting?
That's the question. Something to think about. Thanks for joining us on this deep dive into the chaotic world of biotech investing.
It's always a pleasure to look at the numbers.
We'll see you on the next one. Stay curious.
Don't forget to like, share, and subscribe for more.